Right now, a $3.4 trillion shadow monster is exploding. Private credit, the new unregulated banking beast. Most people have never heard of it. It moves silently in the spaces where regulation does not reach, where the world's most powerful institutions lend and borrow without the safety nets that protect ordinary citizens. And yet, its impact could reach every life, every retirement, every paycheck. This giant is growing faster than anyone realizes, and its shadow stretches across the globe, carrying risks that could ripple through the economy in ways we have never seen before. Banks used to dominate lending. They took deposits, measured risk, and lent with oversight. But after the 2008 financial crisis, banks were forced to retreat, shackled by regulation and capital requirements. The need for loans did not disappear. Companies still had rent to pay, workers to keep, dreams to fund. That void was quickly filled by private lenders, hedge funds, private equity firms, and specialized investment vehicles that thrive in the shadows. Unlike banks, private credit does not have insured depositors. There is no FDIC, no central oversight, no clear rules. These lenders can charge high interest rates, structure complex deals, and push money into risky corporate ventures, leveraged buyouts, and real estate projects. When the economy is strong, they profit handsomely. But when trouble strikes, the consequences are invisible, hidden in spreadsheets and boardrooms, far from the eyes of the public, and potentially catastrophic. After banks stepped back, investors began searching for yield. Traditional bonds offered barely a return, savings accounts almost nothing. Private credit promised much more, double-digit returns, stability in a shaky world. Pension funds, insurance companies, sovereign wealth funds, even endowments poured billions into these shadow vehicles. They trusted the institutions managing their money, unaware that behind the glossy reports lay opaque loans and enormous hidden risk. Private credit thrives in darkness, less oversight, higher profits, faster growth. Simple formula, staggering results. Firms like Blackstone, Ares Management, and Fortress now dominate a market larger than the banking systems of many nations. Their balance sheets are immense yet private. No one, regulators, investors, even governments, fully knows the scale of their exposure. The risks are invisible, and while the profits are privatized, the fallout could be felt by millions of ordinary people. These loans flow into companies banks deem too risky, fueling leveraged buyouts, corporate expansions, and commercial real estate projects that need urgent funding. Short-term, high-interest, complex, structured in ways few outsiders can understand. When the economy booms, profits surge. But when the tide turns, defaults rise, liquidity dries up, and losses are realized. Quietly, often secretly, and always with human consequences. Interest rates are climbing. Central banks are raising the cost of borrowing to fight inflation. Companies burdened with high-interest private loans struggle. Defaults begin to rise. Private credit funds may face liquidity pressures. Unlike traditional banks, they cannot call on central banks for help. Investors may find their money locked, unable to exit, while the assets they funded collapse in value. The private credit market has ballooned to $3.4 trillion globally, almost invisible to most. It is growing faster than traditional banks, faster than the economy, with far less oversight. The size and speed of this expansion make it a systemic risk. When defaults rise, the ripple effects could hit banks, bond markets, and public investors who believed themselves insulated from harm. And behind the numbers, there are people. Real lives. Retirees depending on pension funds heavily invested in private credit could see their income vanish. Mid-sized companies reliant on these loans could collapse, leaving workers unemployed and communities shaken. Municipalities borrowing from shadow lenders might find their essential services imperiled when repayments fail. Everyday people, their wealth, security, and futures are quietly entwined with a system most cannot see, and few fully understand. History offers warnings. In 2008, opaque mortgage products and complex derivatives nearly collapsed the global financial system. In 1998, the fall of a single hedge fund sent shockwaves across the markets. Today, private credit mirrors those characteristics: hidden leverage, limited transparency, complex structures, and interconnections capable of transmitting risk across the global economy. The difference now is scale and the darkness in which it operates. Experts warn that regulators are struggling to keep pace. Private credit is not subject to the same stress tests or capital requirements as banks. Data on outstanding loans, default rates, and leverage is incomplete. Growth is outpacing oversight. By the time warning signs emerge, the damage may already be underway. Investors often underestimate the risks. They are lured by double-digit returns, diversification, and the prestige of lending alongside major institutions. They rarely see the fragility beneath. One sudden market shock, a wave of defaults, a spike in interest rates could trigger a liquidity crunch. Funds could be forced to restructure, restrict withdrawals, or sell assets at fire sale prices. The ripple effects would not stop with the shadow banks. They could cascade into global markets. In times of crisis, private credit behaves differently than traditional banks. Lending can freeze, withdrawals restricted, priority given to select investors. Lack of transparency hides the danger. Stress in private credit can quickly spill into public markets, affecting stock prices, bond yields, and the everyday economy. Some argue private credit has benefits. It fills the gap left by traditional banks, fuels economic growth, and supports companies that would otherwise be denied funding. It has expanded industries, financed projects, and generated returns for investors. But every benefit carries risk. When risk is hidden and profits privatized, the system as a whole grows vulnerable. The signs are clear: rising defaults, widening credit spreads, illiquid funds, slowing economies. Each could signal stress before a crisis unfolds. Yet the lack of transparency makes proactive action nearly impossible. The market moves faster than regulators, investors, and the public can respond. This system touches everyone. Whether you realize it or not, your pension, investments, or employment could be impacted by the shadow of private credit. It is silent, powerful, opaque, and growing. Ignoring it could carry profound consequences. Understanding private credit is no longer optional. For investors, policymakers, and anyone relying on financial stability, education, transparency, and careful risk management are the only defenses against a system that has grown too large to ignore. Right now, $3.4 trillion is quietly expanding in the shadows. The story is still unfolding. The risks, the profits, the human costs, all are real. All are happening in real time. Whether this shadow system thrives, falters, or triggers wider consequences remains to be seen. The question is simple: can the world survive the unregulated expansion of private credit? Or is this the beginning of a new financial storm?